This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Andrew Ziffer, the one of the partners of Greenleaf Capital and their head of retail investing, also a school board member in his local precinct over there in DeKalb County. So great to have you on today, Andrew. Today we're going to be diving into a topic that I really feel from the real estate investment perspective needs more attention. People tend to get caught up a lot in the commercial residential space. Apartments are big, they can be sexy, they're marketed a lot. Residential single family gets a lot of press because it's accessible and people understand it very well. At some point in your life, unless maybe you grew up entirely in Metro Chicago or New York, you've probably lived in a house, with four walls and a roof at some point in your life. So you have some basis of understanding of that type of asset. But retail investing is something that I think just again gets overlooked for no other reason than people just think maybe retail is dead. You see places like Amazon and, your Walmarts and your Targets, and you think, well, everyone just buys stuff from those places. But retail investing is so much more than just that. Kind of understanding it from the perspective of where capital comes in, if you're looking to be investing in it, where values can be added. And again, just kind of understanding how it works in general is important for people. We've had a few different people on here talking about retail, and I get really excited when we have people to come on and talk about this topic, because if you're not looking at retail as part of a general scope of what your real estate investment lens is, I think you're doing yourself definitely a big disservice. So Andrew, really appreciate you coming on today to talk about this with us. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in your current position at Greenleaf, and we'll go from there.
Well, that's actually kind of it's a good story or fun story, but I mean, I believe it or not, I have to throw in my Gator plug, but I'm a University of Florida graduate, and since I graduated, yeah, go. You say go Seminoles? Is that what you said?
I grew up in Tallahassee. I'm sorry, I got to do it.
Oh, we should probably end the interview now. Um, but I grew up in West Palm Beach, so we both grew up in Florida, I guess.
Yep.
I'm a computer science college of engineering graduate. So believe it or not, when I graduated from college, I was developing software in Melbourne, Florida, and then in Atlanta, Georgia. And then I had this crazy idea of I went to my wife one day and said, hey Janet, I want to do this crazy thing. I want to quit my high-paying IT job and go buy an apartment complex. And she kind of looked at me and said, "Okay, sure." And so that was 2003. And needless to say, it was a big journey. It was a huge, huge journey. Multifamily. I had some rental houses. I had two apartment complexes. It was a huge journey, and it was a job. It was a job. I mean, for a couple of years, I went to work every day in shorts and a t-shirt, and I brought lunch every day. I brought a sandwich because my wife did not let me buy lunch, and so that's what I did from 2003. And then for everybody who follows real estate, 2008 happened, so it was not a good necessarily journey, but 2010 for 2017 when I finally cashed out, that's when the boom of the multifamily market was, and in 2017. I sold my two apartment complexes for the most per unit sale of that year that anybody in Marietta, Georgia has ever sold them for. But then, of course, 2 or 3 years later, somebody sold it for more money. And then 2 or 3 years later, somebody sold it for more money because the multifamily just went absolutely bananas. But in 2017, I said, okay, well, what do I do now? I had a job. What do I buy? Because I had to do, I'm assuming you've done stories on 1031s before. Have you done that before?
Oh, yeah.
Yeah. So I basically I did a 1031, a tax-free exchange, and I had to buy something because I didn't want to pay taxes on the proceeds from the apartment complex. And of all things, I said, you know what? I'm just going to buy something easy. So I bought a Zaxby's fast food location, the real estate, not the business, and then an Applebee's location. One was in Cobb County, Georgia, and one was in Dawsonville, Georgia. And when I bought that with, and what also happened is I sold my job
Yeah.
So I went from showing up to work every day, running an apartment complex and doing whatever you needed to do, to having two, I had, 100 plus tenants every year, to having two tenants. And let me tell you, like, the joke of the time is, from 2017 to 2018, I sat home, I did laundry and went grocery shopping. My wife doesn't think that's funny, but basically that's what I did for a year. And then in 2018, my business partners Josh and Dave came to me and said, "Hey, how would you like to build a real estate business at Greenleaf?" And that was 2018. And I said, "Well, sure, why not?" And so 2018, we formed a real estate practice at Greenleaf, because Greenleaf was also in the apartment business, and primarily the apartment business. However, they have also shifted into office, medical office, industrial, and all sorts of other types of businesses. And retail was one of the businesses they shifted into. And so I became the leader of the Greenleaf retail business. And 7 years later, we're I think about 25 plus or minus transactions into the business. We've bought and sold a bunch of properties. We've done really well on some. We've done okay on others. But the common denominator is always that these are very predictable assets.
Yeah, and that's one thing that I really enjoy about the retail space is that rarely, um, and there are certain exceptions, but rarely do you see a lot of vacancy within the space, right? You'll see, just like with everything, it ebbs and flows, but for the most part, at least, just the tangential information I see in the area I live down here in St. Pete, Florida, most of them are all pretty much leased up with very few, vacancies to that effect. So I've always seen it as a pretty, stable asset. And again, just like with real estate, location, 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 if you're trying to invest in retail in a very sparsely populated area, or if you're trying to invest in retail in something that doesn't have good job growth, wage increases, good migratory patterns for people coming into the area and migrating, then, it's probably not going to do well. Just like an apartment complex that wouldn't do well, just like a single family home rental wouldn't do well. So, a lot of the drivers, at least from the economics, from what I see happening in your, kind of standard residential commercial and your single family markets typically kind of drive a lot of the economics from this perspective as well. So the first question I like to ask anyone when it comes to getting invested in real estate, and we're going to kind of focus a little bit more on the aspect of the retail, but what was kind of what were some of the first lessons that you learned when you first, dipped your toes into the retail space? Again, you kind of wet your beak on the, commercial side by jumping headfirst out of, software development into owning an apartment building, which is impressive and something that I would say probably isn't copied by too many people. But, when it came to kind of getting into the retail space, what was some of the things that really, piqued your interest or was a driver to say, hey, look, this is where I should go next?
Well, really, it's about um, for me, it was timing, believe it or not. Because when I sold my apartment complex for a really high value per unit. And during that time, I looked at the other apartment complexes and said, wow, that's a crazy price. That's really expensive. I'm not going to buy that. And so really, I just had to look at, where can I place money that's going to be somewhat predictable and somewhat reliable. And I looked at, oh, why don't I just buy a triple net lease, a lease property? Your rent is basically laid out for you the rent could be laid out for literally 20 years. It's predictable. You get predictable rent increases, and there's nothing for you to do. Essentially, for a triple net lease, we could talk about double net leases when you want to, but for a triple net lease, your basic job is making sure the tenant's taking care of the place. He's fixing roof leaks. He's making sure the parking lot's maintained. Insurance is paid on it. And then honestly, your biggest job is just to make sure the tenant is doing what they're supposed to do and paying your mortgage every month. And there's very little work to do. I mean, I've kind of alluded to this before, but I sold my job. So for me, it was about making life a little bit easier and then also having a stable paycheck. And so those two businesses provided a very stable paycheck. I knew what I was getting every month. The expenses, there were no expenses. The only expense was essentially debt. And as we know very well, unfortunately, interest rates do go up and down. And so when I bought these properties, interest rates were super cheap. Interest rates right now are a little bit higher. And so, interest rates also affect the profitability of these type of deals too, which is, just part of the game. So, when we have to refinance when we bought property 4 years ago, we were financing property at like 3% or 4%. And now, unfortunately, we're financing property at 6% or 7%. So that makes a big difference.
Yeah, and the key point that I'd like to kind of drive people to looking at with this is that, people tend to lump commercial real estate into one big bucket, and typically the thing they look at first is your apartment complexes, which I really feel is something that you need to wholly separate when you're looking at this type of commercial real estate, right? Because it kind of brings in a nice bridge between really being passive and hands off and the attractiveness of being on the lending side of the equation. People really like to be lenders because, hey, just it comes in, you don't have to do any of the property maintenance, insurance, deal with any of that. And when you get into commercial leases, especially in the triple net fashion where the tenant is responsible for any maintenance, insurance, anything that goes on with the property, tenant's responsibility, they just pay you. It kind of gives that nice intermediary between being able to own and control, being very passive, but also getting to take advantage of the appreciation and the equity, which again, real estate does many things, but it appreciates over time. Very rarely does it have any type of, you know, reciprocal on at least the value proposition of just what it will do being held long enough, is really something that's nice to look at when you get to deal with commercial leases instead of residential leases. So when it comes to getting into the triple net space, what did that first kind of deal look like for you? Was it standalone? I know you said you mentioned a few different fast food locations, but was it something where you looked at strip centers? Was it looking at standalone? What was kind of your first foray into those first few deals?
Well, I think one of the, I mean, not necessarily issues, but I was coming out of an apartment complex, and my apartment complex was it was low to middle income apartment complex. Tenants were not uh, they were not reliable payers. There were always evictions every month. It was a lot of work,
A
and
lot of
I
work.
came out of this as like um, I wanted something different and possibly easier and more reliable. And so when you have a person who is working at I don't know, just some type of construction job versus that's your tenant versus your tenant is a big, massive, multi-million dollar publicly traded corporation. I mean, it's a completely different tenant. So with my first deal was an Applebee's. It was an Applebee's in Dawsonville, Georgia. For anybody in Georgia, you've probably eaten at it before if you go north and on 400 in Georgia. But I owned that for a while, and it was just a stable paycheck. It was backed by a very large franchisee in actually Metro Atlanta, and they were based out of in Buckhead, which is in uh, basically just in the sites of the city of Atlanta. And it was just a reliable paycheck, and it was just very easy. It was just very easy for me. And so ultimately, that was kind of the experience. It just made my life a lot more predictable, and there was a lot less to do. And so then I had to figure out at some point like what else do you do? And of course, later on, I told you I went back to Greenleaf and actually created a retail business. And so um, you could, for the amount of effort that it took me to manage two apartment complexes, I had myself and a staff of about four people managing two apartment complexes. Um, at Greenleaf right now, I probably have effectively a staff of two or three full-time people, maybe even two and a half full-time people managing 20 properties. So it's a big order of magnitude different because the level of effort and the level of what you're doing is a lot different.
Yeah, absolutely. And was there, kind of to draw the comparison to being on the debt side of the equation, did you ever look at being on the lending side of the equation, or have you always been kind of focused on the ownership side? Because there's a lot of corollaries that can be drawn between, being a commercial lender versus being a owner of something that, is run triple net.
Yeah, we've done both sides. So we've actually purchased deals where essentially Greenleaf set up a limited partner who was the actual lender on the deal, and we set up a limited partner who was the actual investor in the deal. Now, when you're on the debt side, you're basically just getting a fixed return of XYZ, and then when you're on the equity side, you're getting, whatever cash is left over and the profit of the deal. So it's just a difference. So we've done both. Me personally, have I been the lender on a deal before? No, not really, but as a company, Greenleaf has done that before. The being on the lending side is probably um, it's more predictable too because you actually know what you're getting. Whereas, if you're buying a triple net piece of real estate, every year you're going to have something different to pay for, possibly like an accountant or some type of professional fee, or there's always something to do. You have to ask a lawyer a question, and every time you ask a lawyer a question, it costs what? Good, costs $25,000 when you ask a lawyer a question.
Yeah.
I was joking, but um, so um, but we at Greenleaf we have actually done we've done loan side on many different types of transactions like individual residential lots. We were going to do it on some, believe it or not, of all things, airplane hangars. So we were
Hmm.
going to we were going to do that. And so, there are different options. And um, it hasn't been my focus. My focus is usually just on owning real estate and being a landlord and making sure the real estate's operating really well and really efficiently with our internal side and our internal business, our internal expenses, how we organize it, and what we're doing on a day-to-day basis, making sure our tenants are happy, of course, making sure rent's collected. So there's also that. That's the
Yeah.
important part too, making sure rent's collected.
Yeah, and the reason I ask is that just at least from my, own personal, experience, and I've been in the alternative asset and commercial real estate space for 14, almost 15 years now. So just kind of getting to see where some of the, similarities in real estate investments lie. And again, from a dollar perspective, I'd probably rather be on the equity side. It's, you do have the predictability, but it is something to really make money at the lending side. It's an economy of scale larger than the amount of capital for the equity side of getting to take advantage of rising prices as opposed to stability. So with everything, there's a trade-off, right? The risk of owning something that comes with that, but also the stability of debt. It's a question I like to pose to people.
Well,
Now,
when you're doing Advanta deals, could Advanta actually be the debt on a deal?
no, no, we have to stay just as the record keeper. We're just fancy librarians at that
Oh,
point.
right. But could your investors be on the, like they buy a
Yeah.
property and just be the debt?
Oh, absolutely. And the interesting thing about that, just from a purely observational status, is that I think if you look at I want to say the top five most valuable account holders that we have that have the most net value in their accounts, the majority of all of those assets are loans. That's how they made their money, is all being lenders on stuff. So I find it very interesting that that actually has happened. And from talking to other people in our industry, that seems to be a big common thread. It's not the crazy, exotic, extremely sexy investments. It's people that understand how to be lenders, have made just a massive amount of capital in these accounts. Which again, it's anecdotal. And I mean, it might just be purely coincidence and chance. I doubt it. There definitely is something to that. But, looking at accounts that have something to the order of like, 30 mortgages in them and tens of millions of dollars of value that have just been residential fix and flip lenders, have made a absolute killing
Yeah.
at doing it. So it's interesting to see. Is the tortoise and the hare analogy play out there? Maybe. I don't know.
Well,
Um,
I will say that, when you have $1 million in an IRA and, you want to invest it in something versus $10 million in an IRA, you could invest the $10 million and just get like a 6% or 8% or 10% return on that. and do a lot better than being on the equity side of a deal sometimes because it's also predictable. And when you're lending money, typically you're lending money at a 60 or 70% loan to value. So if anything ever does happen, you always get your money back. So maybe I should be doing that too. You want to put me in contact with your lending people and I'll start doing that too.
Man, it's one of those things where just from my experience being in investment banking for for the years that I have been, it's been the lessons have always come from interesting places, right? I came in with my degree in business administration and finance, thinking that hey, I'm gonna learn all this crazy stuff, and I was thinking for a long time I was just gonna go work for Raymond James down the road here in St. Pete, be a stockbroker, be a financial advisor. And just the cool, interesting stuff that I get to see on a day-to-day basis that has changed my belief in investing in general has been really cool. Just seeing where people make money, and especially in real estate, how expansive many different places you can make a buck by just looking at four walls and a roof of something is beyond cool in my opinion. It always gets me fired up to talk about it. So to kind of yeah.
As a changed how you invest money personally then?
So I'm kind of like the vegetarian butcher, right? I do it all day. I preach it to people, but man, I get home at the end of the day, and I just like stocks, bonds, ETFs. I will say though, private securities is something that I like just because with how hands-on you have to be with some to do self-direction, doing it for my clients all day, and then having to do that kind of same stuff for my retirement stuff. It's how many hours of the day. But I like private stock, especially like banks and things like that, financial institutions and private stock. That's where I kind of enjoy operating in that space because it kind of gives me a lot less of the overhead of real estate, but with getting relatively stable returns within the mechanism, something that's pretty stable. So that's what I like in some commercial real estate. But again, I have the problem with investing is that I have conflicts of interest with basically any good deal that comes along. It's like I have a client invested or the GP is a client of ours and I can't do my 401k and stuff like that. So just personally how it steers me away from some of it. A bummer for
Well,
sure.
I will say anybody who buys real estate or anybody who goes in any form of small business, I mean, I think a lot of people who do it, and I'll include myself in this, they go into a small business or they start a small business, and quite frankly, they're just usually, they don't necessarily understand the consequences of doing it until they're
Mhm.
doing it. And then, a lot of people, they just kind of fold and say, okay, I can't do this anymore. And they get a job and they just sort of ride out into retirement. And then a lot of people suffer through the business and figure it out. And, they do well. I mean, like I've been doing this, I went on my own in 2003. So I'm 22 years into this. And I will tell you, it's been a ride. It's
Mhm.
been a ride. It's some really great years. And there's some years you want to say, holy shit, I can't believe this is happening. Am I allowed to say that?
But yeah, I think especially with the real estate crowd, I think they echo the sentiment.
Yeah.
Specifically that it is, but also it's kind of that same thing offers the stability to weather those storms, right? Whereas the opposition, if you're just invested in securities, and let's pick on dividend paying stocks for a second, right? Your income is direct correlation to share price, right? So if that value goes down, or if it goes to nil, or if it's suppressed for a very long time, or maybe there's a buyout and there's no more dividends being paid, that is a like almost a live view of cash flows diminishing. Whereas you have so much of a nicer buffer in real estate, right? Especially, and let's, to go back to commercial leases, especially, you might have a 5 year term on a lease, right? That business is trying to stay open, right? They are, making sure that they have a place. So there's a lot of incentive to make sure those cash flows come up. And do businesses go out of business? Absolutely. Tenants move. You're always going to have that aspect of the risk profile when you're looking at this. But the real estate value could go up twofold. It can go drop by half. That rent stays the same, right? I like the what real estate offers is the ability to invest. If you're investing for cash flows, to invest to a point of being price point agnostic. Obviously you have to get a good deal. You can't pay through the nose through something and then just expect, the cash flows to make sense. It's unless you have enough money to where it doesn't matter, which I would like to take you to dinner and get some of that money for my investments, but it gives you the ability to buffer what you're doing with steady cash flow, right? And cash flows that do appreciate over time in general, with an asset that will, given a long enough period of time, appreciate over time to the and it with how the velocity of values go, it's nice for that aspect as well as that it's not dynamic as a stock market can be, which people make millions of dollars and billions of dollars in the stock market, but real estate offers a significantly larger hedge on stability, which is, that's something I really appreciate about it.
Yeah. Unless, of course, you invested in Tesla like 15 years ago, and then that's all you did. That could have been all some people ever did, or Nvidia a few years ago. So, and
Yeah, and I always kick myself. I'm never one to hold that kind of stuff. I made good money. I think I made, I invested my investments in Tesla. I think I played around with it between about early 2019, and then I sold my last bits of it in 2022. So I had a good run with it. I'd had a much better run if I continued to hold it or if I gotten in earlier. But
yeah,
you can always kick yourself. But I rarely do I find people ever, kick themselves for buying real estate unless you just really miss the mark.
yeah. And
Investing in real estate, if you give it some time, will again, I would have to really I have to think very little about people that invest in real estate and like it. I have to think very, very, very hard to think about people that invested in real estate and that I can't think of a reason that just jumps out at me that they had a bad time. um,
Yeah,
it's
I mean, there's
kind of
bad times, but ultimately, works out. And the big, not the big sort of saying I use is the big mantra is time cures most of your real estate wounds. So,
yeah,
if you just wait things out, things usually get better. Like, honestly, when I bought my apartment complex in 2003 to 2009, so 6 years roughly. I mean, it was flat rent. It was, okay market, nothing great, but it was nothing great. I mean, rent growth, I had my apartment complex for 14 years, and I don't think I had rent growth until like probably the last 7 years is when the rent growth started. So, I mean, it just happens. And, real estate values also change too. Like Dollar General, it's one of our favorite things we buy right now. And Dollar General cap rates over the past 20 years have progressively gone down, which means the prices go up. But honestly, over the last few years, Dollar General's had some challenges with its stock price. It had one little stock dip, and it became a buying opportunity because the Dollar General values went down. And so we bought a bunch. And now the Dollar General values are kind of back up to like, you could still find some deals, but ultimately, you know, we're always going to buy value. And so we're always looking for that value deal. We're looking for the piece of real estate that's located very well. It does really well. And the tenant, um, one thing I do when I buy real estate is I want to make sure there is no reason for that tenant to move out. So I want to make sure their rent is reasonable. I want to make sure their site is reasonable. And I think you were talking about this before, population growth, but population growth is super important because as long as there's population growth, there's growth in the area. But that also means if you own an Applebee's, that means a Chili's could open up across the street and cause some problems for that Applebee's. And then Applebee's calls you back and says, hey, we're not doing so good since that Chili's opened across the street. And it's not always perfect because when a renewal comes up, they'll say, well, hey, we're not doing so well, so we want a little bit of a break on rent. And so that happens all the time. So then it becomes a little bit of a negotiating game because a lot of these triple net leases, they have 10 to 15 to 20-year initial terms, and then they go into 5-year option periods. And so typically the value is always going to be at the last 5 years of a lease or even the last 2 years of a lease. You want to buy that short lease property and then buy it and then get that lease renewal. And then just by getting that lease renewal, you turn a 2-year lease into a 5-year lease. That 5-year lease property is worth more than the 2-year lease. And that's a
yeah,
lot of what we do.
yeah, I think that's a really good kind of way to segue into this of looking because unlike your apartment complexes where you come in and say, okay, here's where the value is going to be added, right? We put new finishes on, we have new marketing for it. There's a lot of stuff to do to kind of, increase value, fix the pool, better lighting, have pay for parking. Like there's a lot of stuff that can be done from a value proposition to, have an appreciable rent increase, right? To take that property from the B to the C or the C to the B class, the B to the A class, whatever it happens to be, or marketing term you want to use for it, it's a little bit easier identified. But there's definitely a lot more that goes into when you're looking at commercial leases that where you can really drive that value. And you hit on a really good point is understanding kind of the basics of what a commercial lease is, right? So from the perspective, we've already kind of defined triple net, right? Basically meaning that the tenant is taking care of everything: taxes, insurance, repairs. It is the three main drivers of expenses they are taking care of, and you sit back and make sure, one, they're paying their mortgage, two, that they're if there is debt encumbrance, they're paying insurance, making sure there's not a big hole in the roof that's flooding out other tenants, like making sure they're doing what they should be. But at the end of the day, you're just collecting that rent in. Don't have to deal with the tenants, termites, like was the three T's of real estate: tenants, termites, and toilets. You're dealing with
Tenants,
just
termites, and toilets. I haven't heard that before. I'll steal that from
um,
you.
that's what my lenders like to say. It's like, hey, if you want to be a lender, you don't have to deal with tenants, toilets, and termites. Great. But that's what you're kind of dealing with. But it's also important to understand how the terms of these work. And you brought up exactly what I was going to say is that, the term was typically going to have an option period, and how you kind of look at pricing for some of these things is directly related as to the average of what your tenant leases are looking like. So let's kind of look at that. When you're examining a property, again, let's kind of define from your perspective what typical commercial leases are, right? Like what's the term, and let's get into a little bit of kind of how that optioning period works.
Well, so for example, the Applebee's that I bought when I sold my apartment complex, the original lease on it was 20 years. The builder built it, and then what usually happens is the developer comes in, builds something, and the developer will make us. They're spending a lot of money building this place, and the way they make their money back is when they sell it. Now, what also happens too is this: the seller, or I'm sorry, the developer and the tenant also agree to a rent, and based on that rent, the developer can kind of predict what the sale price will be based on market conditions, and so they know they're going to make a spread on what it costs them to develop, and then what they're able to sell it for at a certain point. And then the first investor owns it. The first investor, could own it from anywhere from 1 to 20 years, who knows? But they're getting they're basically buying a bond. If something is brand new, 20-year lease, credit tenant, that tenant's going to be there, pending any surprises for a very long time. There have been some surprises in the industry, like what's the last uh, retail brand that you saw that went out of business? Do you remember O'Charlie's?
Yeah, those. I mean, yeah, it's hard to think of. I mean, you definitely see some retraction, like, but like also it's like from the perspective of like um, you never see a Chick-fil-A that closes, right? You never
Oh
see.
God, Chick-fil-A. Chick-fil-A is just like I don't know. Chick-fil-A's, they sell at such incredibly high prices. It's absolutely amazing. They sell
Yeah,
it
or
like
you
four
don't
and
see a
five.
public. You rarely see a Publix that closes, right? Like,
Yeah,
you know,
yeah. So there's some really premium brands that go for really low cap rate means high price, but there's some really premium brands. And we fall into some premium brands, like we have a DQ, and DQ seems to be trade pretty well, and we also have a Panera that trades pretty well. But Chick-fil-A is pretty much the top of the fast food chain as far as real estate concerned. Even McDonald's, believe it or not, is. But McDonald's usually have longer leases, and McDonald's are always on like they're on that corner with a 6-lane interchange or whatever, and so they're always on that piece. That was the whole premise of McDonald's. It's not You're not selling hamburgers, you're buying real estate, and so ultimately, you're just well located. But the you're ultimately buying the credit of the tenant. So Chick-fil-A as a tenant is an amazing tenant because Chick-fil-A's, they're not necessarily franchised. They have this owner operator model, but the Cathy family, they essentially own all their property. They might not own the real estate, but they definitely own the business. And it's just um, I have for whatever reason, Chick-fil-A, even Raising Cane's is coming to Georgia. Where are you located?
St. Pete, Florida.
Okay, you don't have Raising Cane's yet either, then, do you?
Well, I had Raising Cane's on Saturday.
Oh, so they've made it to Florida.
Yeah, they're down. The first location down here, I think, was in Clearwater, up the road from me. And then they put one way too close to my house.
Meaning
Yeah,
that
like maybe like a mile or two.
you eat there too much. Is that what you're saying?
Oh, that was the first time I'd eaten there, but they also just opened. But it is, that sauce is so good.
Yeah, yeah, and I love. We have three Zaxby's now. I love Zaxby's and Raising Cane's are a competitor. Chick-fil-A is of course very amazing, and then there's Whataburger now is coming to the southeast too, so they're developing right now. But ultimately, when you're buying one of these brands, I mean, think about the quality of your tenant.
Hmm.
Do you want to have a somebody who works in a medical, I'm not trying to insult anybody, but do you want somebody who has a job as a medical office assistant, or do you want to have Chick-fil-A as a tenant? Pick one.
Yeah,
So you
absolutely.
get
Yeah.
yeah, you get where my head was.
Yeah, Chick-fil-A, because and if you talk about places that you see closing a lot, I see medical offices closing left and right. I do see a lot of like consolidation and migration. Um, just going out to the beach. I'm just thinking in St. Pete, there's a urology group that had one from my house going out to the beach. There was two locations and both have closed.
Yeah, and you just have to think about, something really has to go wrong for that Raising Cane's to close by your house. Like they must have really got their business plan wrong. And honestly, if that Raising Cane lasts 10 years, it's going to probably be there indefinitely. And at year 20, my guess is they're going to mow down that Raising Cane's and they're going to build a new Raising Cane's because they're going to build the new modern prototype and they just want to, they want to make it look like a normal Raising Cane's rather than the old Raising Cane's. So, I mean,
Yeah.
there's a lot of these. Think about when you were growing up. Wasn't there a fast food restaurant that was like there your entire time you were in high school and college?
Oh yeah. Well, there's a funny one. There's a Taco Bell in St. Pete that my dad grew up in Bradenton, which is just south of where I live now. And in the 70s, the first Taco Bell in this area of Florida was in St. Pete, and that it's still there. It was opened in like 1978 or 9, and it is still there today.
That's 45 years or 45 plus years. Have they,
Hmm.
have they mowed it down and built a new one?
I wish they would have. It is they have the new modern aesthetic, but man, that thing is it's right on the corner of US 19 and like I want to say like Ninth Ave North or something, and like it could definitely use for them to buy the daily rate motel next door and raise it down and maybe increase some parking. But yeah, it's still there, a little
Yeah.
nicer, but
And I'm assuming that restaurant's had a couple of renovations inside. And Taco Bell
yeah.
is, at 10 o'clock at night, Taco Bell is still amazing.
It always is. I need to get less people in my life that talk down about Taco Bell.
Yeah, my wife does not like Taco Bell, and that's a problem sometimes for us. But my kid and I both like it. But I always
Yeah.
like the seven-layer burrito. Actually, I don't know if they make it anymore. But yeah, whenever you're going home and it's too late, nothing's open, Taco Bell's always there.
Taco Bell's always there for you. Taco Bell's
Yeah,
always.
and the Taco Bell near our house, and I live in Dunwoody, Georgia. Taco Bell's been there for as long as I've been here, so I think it's 30 years. The Taco Bell's been there for 30 years.
Yeah, they're a very sticky tenant.
Yeah.
So let's kind of maybe transition a little bit into kind of the market for this stuff, because again, we're really talking about the stability of the asset class from the perspective. Obviously, you have to choose your tenants wisely, right? It's and I kind of made this joke with another retail investor. If someone's in there and they're the the asbestos distributor for the area, it's like maybe look at who these people are, and if there's stuff that's not going to be you know pervasive, right? I would think,
That's a good one. Asbestos distributor. Yeah.
but I would pick on things like, vape and kratom shops, right? There's probably a lot of things that, they're popping up everywhere. I mean, almost any location probably sees a ton of those things popping up. But, is it going to be something that's going to be subject to, legislation and restriction, right? Everyone needs groceries. Everyone doesn't need fast food, but let's be honest, we all love it. So it's, going to be there. And by virtue of the fact that you see these things stick around forever, probably, again, a good thing to look at. So, from kind of the markets that you're looking at, how, is there a reason that you focus specifically on certain markets? And again, is the tenant profile that you really like, is it mainly retail and food, or are there other things that you'd like to focus on, grocery at all, or any other types of other tenants that you really kind of gravitates your, the capitalization of where you deploy it versus another?
Well, it's a good question. It's a good question. I would say number one, we're focusing on probably that $1 million to $5 million deal. The sweet spot for what we buy is around that 2.5 to maybe $3 million marker. Um, and then we try to hit that. It's honestly it's very expensive to buy a $900,000 piece of property because it costs there's certain expenses that it costs the same to buy a $900,000 piece of property that it does to buy a $2 million property because the closing costs are all still very similar. And so then we try to get some, scale. And so if we're buying like, $1 million property, we try to buy two of them to kind of reduce some of the costs and make the closing costs kind of a lesser percentage. But so we tend to focus on single tenant. We tend to focus on less than 5 million. We have looked at strip centers before. In fact, one of the best things I ever did was buy a strip center. We bought it for a year and we sold it for, I think it was like a 45% return on cash. And so we did really well on that.
Nice.
It was a mattress firm, Aspen Dental, and a vitamin shop strip center. Okay. And it had and so we did buy that. We sold it, did pretty well on that. And so, that's kind of our target market. But, I will say when we're buying retail real estate, we want to ensure longevity. I mean, that's the number one important thing. So we want to ensure that the location is established. We don't want to buy something that's been there for a year and the tenant's telling us, oh, we think we're going to be able to survive, but we're not sure. And I know we have that 20-year lease, but our sales aren't what we expected. So, that's the worst thing you could hear. So, after somebody's been there for 5 or 10 years, they kind of have a good idea what their sales are. They have a good idea of their growth, and you have a good idea whether they can afford their rent. And then we also buy data. And so this is the I'm not going to say this is the spooky part of it all, and probably the stuff people don't want to hear, but we buy foot traffic data. And so we use a service called Placer. Have you heard of Placer?
Yeah, I've heard of it.
Placer is an Israeli company, and they buy cell phone data, and they track foot traffic. So when we're buying like a location like a Zaxby's or a Dollar General, we know the foot traffic going in and out of that location. We might not necessarily know the sales, but we know the foot traffic. And then we take that foot traffic and we say, okay, if we're looking at a Zaxby's right now, this is the foot traffic for that location. How does that Zaxby's compare to all the other Zaxby's in the US? And so we can get like, how does this Zaxby's compare to a 50-mile radius inside Georgia around it? How does this Zaxby's compare to all the other Georgia Zaxby's? And how does the Zaxby's compare to all of the US Zaxby's? And so we have a good idea that, okay, this is a top percentile Zaxby's, a bottom percentile Zaxby's. And based on that, that's how we make our sales decisions or our buy decisions, because we have a clue. We might get sales for the location, and then we also know that it's a top performer. Sometimes we don't get sales, but then we know foot traffic. And when we see that this location is in the top 90th percentile of all of their entire system for their brand, I mean, we know we're making a good decision. And so that's ultimately what drives a lot of our buying decision.
Now, are you ever in the position, at least, from saying, okay, do you ever get into kind of the value add for optimization by taking that data and saying, okay, well, we can see that, let's say, like parking lot design or something like that, where you can see like a definite like bottleneck or something, or do you really try to stay away from that and just invest in things that are, I hate the term turnkey, but again, that really don't need that kind of optimization, right? You look at, from a data perspective of, okay, foot traffic and other metrics, where they're at in their lease cycle, and those are really kind of the drivers, or do you get into much of the value add investing when it comes to retail?
Greenleaf as a company does, I mean, honestly, outside of retail, Greenleaf, that's his business, value add. So like we bought a kind of a mixed use industrial retail center. And, a lot of times with these bigger pieces of real estate, they need some type of capital infusion to improve the property, to collect better rents. And sometimes honestly, the owners are just tired and saying, look, I'm just done. I don't want to do it anymore. I've made my money. I'm going to sell this. I'm going to, sometimes they might say, oh, I'm just going to sell this and go buy myself a 20-year triple net lease and coast into retirement. But they just don't want to make the capital infusion. So Greenleaf comes in, we model what it needs. We kind of model, okay, if we fix it up and we spend this much on it, we fix the roof, we fix the parking lot, we paint the location. In fact, in our office right now, we did this to an office space. It's in an industrial area. what's it going to take rents from $8 a foot to 12 or 13 or 14 or $15 a square foot? Like, how do we do that? And so uh, that is something we do, and it just depends on what is the asset type. Is it we do it a lot for industrial, we call it industrial flex. So we call it office in the front, um, party in the back. So garage door, storage.
Mhm.
Like for example, like a plumber or an electrician, they would have offices in the front and then some type of utility area and storage in the back. And so we accommodate those type of tenants. And so yes, yes. The and sometimes what it could be? Value add could have nothing to do with any physical improvement. Value add could just mean leases.
That's a big part of the retail space that I've talked about with other people too, especially if people are on a double net lease structure, right? It's not always just an increase in rent; it can be a decrease in your expenses too. And with commercial leases, if you can take something that is, especially in kind of that option period, and say, okay, cool, we're going to triple net. Again, businesses like to be sticky, and if the entire market is triple net, it's the stroke of a pen. You can get rid of having to pay property insurance.
Right, right.
It's,
And
it is
you can change it from like a double niece. A double niece, just to be clear, is that means the landlord has some responsibility, like you could be responsible for roof and parking lot, and the tenant's responsible for everything inside. But the strip mall that I was talking about before that we bought and sold, the only thing I did to that strip mall, I mean, aside, we do little things to make sure, we always maintain the roofs, we maintain whatever needs to be fixed, we fix it. But what I did is I changed the leases from short leases to long leases. And when I changed the leases from short leases to long leases, that improved the value of the property.
Yeah, absolutely. And again, there's perspectives on also your, how are you going to dispose of this property? Is this something you want to hold long term or do a value add and then claw your capital back out of it, right? If there's something that can take a ton of simple like pin stroke value adds, right? Change everything over to a long term triple net lease. Maybe you didn't want to necessarily be in there, but there's so much value to be added that can increase the equity to turn around and sell it. There's the really cool concepts of things that don't take a lot of money in retail, besides obviously needing to have enough to buy the property. Unlike your commercial residential space, where your value adds are going to be a little bit more capital intensive, at least from my perspective, right? If you have to go in and put in countertops in 100 apartment complex, 100 apartment units, along with toilets and painting and everything,
Yeah,
I think it's
like
expensive real quick.
value add
Um,
for apartments is never just going to be about going in there and making longer leases. Value add for apartments, they're going to be heavy lifts. It's going to be spending money. It's going to be investing a lot of money, so it's capital intensive. But sometimes retail, the value add is literally just it's a pen and a piece of paper. So that's what's different.
Yeah, and again, that's something that I think people often think of retail just as, going and buying, what Amazon is. And it's not that, right? But retail is anything, any storefront that you go and buy something from is retail, right? So that can be everything from, again, there's just to pick on the shopping center next to my house, which has a Publix, which is awesome. I love that Publix. It just redid it. Thank you, Publix. But there's an Amscot in there. There's a gas station in the parking lot. There's a bingo hall, which is a riot to go to on a Friday night. If you've never been to a bingo hall, there's a Subway. There's a Chinese spot. There's a PetSmart. All these things are retail. It's not just going in and buying. Again, your Amazon, whatever you buy on Amazon.
Right.
It can be so much more from just a perspective of. There's also a good pizza place in there. There's a lot that can kind of go into it, which also plays into hedges, right? If you are saying if you're just investing in the rental space with apartment complexes, if job growth retracts, there's a lot of things that can affect just people's ability to, rent that apartment or your ability to increase rents. You get a lot of diversity in a lot of different markets. So especially, again, picking on strip, there's, restaurants that have a different metrics and performances, but you could be, if one thing is doing, let's say the one thing is doing bad, but the economy's down and the liquor store is doing great, you got a good tenant, right? There's so many things that can affect this that you get to hedge a little bit on the market uncertainty with having your your revenue streams not just based on, hey, is my job here tomorrow, right? Or hey, can I afford this apartment? There's a lot more things that can diversify potential streams of income, even though it is all rent. But the basis of where that's coming from can be diversified much better in the retail space than in just the commercial residential space.
Um, all right. You just made me think about something too that, just as part of our business, we used to talk about this years ago. We used to talk about Amazon resilient real estate.
Hmm?
So we just do it as a matter of practice right now. But, unfortunately, like malls, you and I grew up with malls being like a
Yep.
thing. And now malls are no longer a thing because, a lot of times high-end retail has moved out of the mall, like, Macy's and all of those, like, you know, poor Sears. Sears is pretty much, I think there's a couple of Sears left, or are
Mhm.
there any Sears left? I think there's a few left. Um, but, when we're buying retail, we want to buy retail that's, going to be there. And so if there is no retail, like for example, would we go out and buy a high-end jewelry store that sells high-end watches? I don't know. Is a high-end watch a high-touch business? So you got to go in, I guess you got to look at it, you got to play with it, you got to see if it works, you got to see if you like it. High-end luxury items, are high-end luxury items moving to Amazon, or do you still go into a retail location for that? I guess engagement rings, there still are some jewelry businesses that do that. Um, like, has Jared's made it to around you? Like Jared's is a big brand
Yeah,
around here.
Jared's is down here.
So, there's still some that are surviving, but Amazon has changed the face of retail. So like even me, I feel kind of bad sometimes that I buy something off of Amazon versus going to REI or Target or buy it there because someone said this to me years ago, and it makes sense that every time you go into a retail location, you're voting. And so I used to go to Publix every week, but now I don't go to Publix every week. I go to Publix maybe once, a couple times a month. But what happened is my vote now goes to Costco. And so, Publix and those, smaller footprint groceries, I never thought Publix would be a smaller footprint grocery stores, are moving to like the Costco model. And the Costco model is almost in itself an Amazon model because it's a consolidation, it's a centralization of fewer things, lower price, and easier to access. And Amazon is about as good as it gets. It's high selection, pretty much lowest price possible, and easy access. And so, what inside retail right now is doing that? Raising Cane's is probably Amazon proof. Taco Bell is probably Amazon proof. So the real question when you're buying retail, but it is that location Amazon proof? And over the years, I'm trying to think of something that's probably went out of business. Pet businesses have changed a lot because you could buy cat food and over the internet, although we still buy cat food at our local what's it called? It's called Hollywood. I believe it's Hollywood Feed. Yeah, Hollywood Feed. I don't know if that's made it to Florida yet. Um, but the face is changing. Even food is changing too because my wife works for a large franchise or some major brands, and she even talks about like people's eating habits are changing. And when the economy's good, you dine up, and when the economy's bad, you dine down. But at a certain point too, a lot of people, instead of going to Raising Cane's, you might be going to the local Mexican restaurant instead because it's a local restaurant. It's just you like it better. It's probably, maybe a little bit more expensive, but it's also, maybe a nicer experience for you versus
Yeah.
Raising Cane's.
Yeah, especially I think those are all fantastic points, and I really hope that through the path of our conversation, people if you haven't taken a stance and thought, hey, if I'm investing in real estate and I'm looking for either my next step or trying to just maybe not always be plugging into commercial residential real estate, retail. It's something that is just too often overlooked from an exposure standpoint for people's portfolios. And again, I don't know why. Maybe again, it's just that, misconception that
I call it the
everything
least
is,
sexy, least sexy real estate, the most predictable, and it's the least sexy.
but hey, I mean, it doesn't have to be sexy to make a bunch of money, right? Just from
Least
from from the example of the mortgages and the largest accounts we have, like being a lender on real estate is about as gray as it comes. Like it is not exciting, but it can make a
Yeah.
ton of money.
You got to
So
look at some of your friends and family who make a lot of money in these really obscure businesses that are completely not very sexy or not very, appetizing, but they make a living and they make a good living doing it.
Yeah,
And
I
retail
mean,
is, it's retail real estate, very predictable, very easy. And you recognize it, it because you grew up with whatever you're buying. You usually grow up with the brand or the brand, and you have an attachment and a connection to the brand.
exactly, and it's why people like real estate. I mean, good example of my grandfather, car lots and muffler shops. It's not the super attractive thing, but real estate related to those, did very well for himself.
How many
So with
college
that,
educations did you pay for? You
uh,
paid,
3 or 4.
you paid for three or four selling mufflers and selling mufflers. So yeah, absolutely.
And used cars. It was when he retired. It was his car lot was the oldest independent car dealer in the state of Florida. I don't know if the metric like what in the southeast, but 64 years of business.
64 years in business. Wow. Okay.
Selling metal, which gave me my love of cars too. Now I'm a big car guy. So thanks, Papa. Anyways, again, really do appreciate your time. The most valuable asset we all have is time because no matter how well we invest, we can't make more of it. So again, really appreciate you being on with us today, Andrew. If people want to reach out, learn more about what you have going on, potential investment opportunities, what's the best way they can touch base with you?
Best way to get in touch with us is if you go to Greenleaf. Actually, I'll give you my the website's greenleafmgmt.com, and you'll see me on the contact or the partner page. My name is right there, and feel free to email me that way. And it's been great. Thank you for the interview. I appreciate the
Absolutely.
time, and
Thank
I'm
you so
always happy
much.
to talk about retail real estate.
Awesome. Well, again, really appreciate you. As always, this has been an edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.